If you're over 60, there's one safe investment that could quietly drain the wealth you've worked your entire life to build. No headlines. No red flags. You go to bed thinking your nest egg is secure, and by morning, thousands, sometimes tens of thousands, of dollars in value are gone. As a financial advisor, I've seen this far too often. And not because of wild speculation in crypto or gambling on penny stocks, but because of something seniors are told is steady, secure, even guaranteed. Popular investments that quietly eat away at your wealth. Yes, really. Investments. Every day, millions of retirees and older investors are putting their savings into products they believe will keep them safe. Annuities, certain mutual funds, high-fee insurance-linked products, and even conservative bond funds. And while some can play a role in a balanced plan, others, especially when bought at the wrong time or in the wrong way, can quietly destroy senior wealth. Today, I want to walk you through the most common trap that's wiping out retiree wealth right now. If you or a loved one are over 60, this might be the most important financial warning you'll hear this year. Don't forget to like this video and subscribe to Senior Wealth Tips for clear, no-nonsense financial guidance built for older adults. Let's start with the most surprising and dangerous investment of them all: variable annuities. They sound like stability in a box. A monthly check for life, tax-deferred growth, maybe even a death benefit for your spouse. Insurance companies market them as a silver bullet for retirement. But here's what most seniors are never told: the layers of fees, surrender charges, and market risk baked into these contracts can quietly erode your savings until there's almost nothing left. Take Mr. Donald Harris, a 72-year-old retired teacher I met 2 years ago. He'd worked for decades, saved diligently, and wanted peace of mind. A local agent sold him a variable annuity with a lifetime income rider. The glossy brochure promised guaranteed checks, market growth, and legacy protection. Donald thought he was safe. But what he didn't realize was that he'd just signed up for one of the most expensive financial products in America. Annual fees north of 3%, surrender penalties that locked his money up for 10 years, and guaranteed income payments that were barely higher than what he could have earned from plain old treasury bonds. Within 5 years, Donald watched $200,000 shrink while the insurance company raked in fees. The growth he was promised? Eaten alive by expenses. And when he needed cash for unexpected medical bills, he discovered he'd have to pay thousands in surrender charges just to access his own money. A wealth drain. Quiet, legal, and devastating. Here's the truth no one on commission will tell you: the so-called guarantees of these products are often illusions. You don't get safety. You get restrictions. You don't get growth. You get fees. And the longer you hold on, the more you pay, while inflation and healthcare costs march forward, draining the real value of every dollar. The scariest part? Many seniors never realize the damage until it's too late. They think the income rider is free. It's not. They think the insurance company is protecting them. It's not. What they've really bought is a contract designed to make the insurer rich and keep them stuck. And here's something you may not know: many annuities marketed as senior-friendly today are actually designed for people who will never use the money. The guarantees only kick in under extreme conditions. The rest of the time, your wealth is just leaking. Slowly, quietly, legally. So, let me ask, do you know what fees you're paying right now? Type fees in the comments if you've ever looked at your statement and wondered why your balance isn't growing. If you've ever owned or been pitched an annuity, this is your wake-up call. Because what I'm about to share next will shock you even more: a so-called conservative investment that seniors flock to for stability, but in reality, it may be setting them up for even greater losses than the stock market. And I'll explain why in the next part. Every week, I sit down with seniors who tell me the same thing: I just want something safe. I can't afford to lose my money at my age. And I understand that fear. After decades of working hard, raising families, and finally stepping into retirement, the last thing you want is risk. So, many turn to what's marketed as the safe zone of investing: bond funds. They sound boring, stable, almost sleepy. But for retirees, these conservative investments can become silent wealth destroyers. Here's the problem most people never hear: bond funds aren't fixed bonds. They don't guarantee you steady interest. They don't promise you'll get your principal back at maturity. Instead, they're pooled funds tied to the ups and downs of interest rates. And when rates rise, like they have over the past 2 years, bond funds don't protect you. They punish you. Your so-called safe investment loses value overnight, and unlike individual bonds, there's no promise that you'll ever get your full investment back. Let me share a story that still weighs on me. Mrs. Elaine Thompson, a 78-year-old widow from Arizona, came to me last year in tears. She'd always been careful. She hated risk. She avoided the stock market. A bank representative suggested she move her retirement savings into a conservative income fund that held mostly government and corporate bonds. Elaine thought she was protecting herself. But what she didn't realize was that as interest rates spiked, the value of her fund plummeted. Within 18 months, her $300,000 nest egg had shrunk by more than $60,000. She was devastated. "I thought bonds were safe," she whispered. And that's the trap, thinking bond equals safety. Here's the truth. Individual bonds and bond funds are two completely different animals. If you buy an individual treasury bond and hold it to maturity, you get your principal back, plus interest, as long as the government doesn't default. That's predictable. That's stable. But with bond funds, there is no maturity date. They're constantly buying and selling bonds, which means if you need your money during a period of rising rates, you're forced to sell at a loss. Seniors who believe they're parking their money somewhere risk-free are often shocked when they see their balances melt away during rate hikes. And there's another danger. Bond funds often market themselves as income vehicles. But what most retirees don't realize is that the income they produce can fluctuate wildly. Dividends rise and fall, leaving seniors struggling to plan around them. If you're depending on that income to cover essentials like medications, groceries, or housing, one bad year can throw your entire retirement budget into chaos. Now, let's talk about the hidden fees. You might think, it's a bond fund. How expensive can it be? But dig into the fine print and you'll find management fees, administrative fees, and transaction costs quietly eating away at returns. Elaine's fund, for example, carried a 1.2% expense ratio. That may not sound like much, but over time, it's a silent drain. Combine falling bond values with annual fees and suddenly that safe fund is as destructive as a risky stock bet. This is what I call the illusion of safety. Seniors are sold investments that sound stable but behave unpredictably at the exact time they need stability most. And it's not just bond funds. High-fee, target-date funds, market-linked CDs, and exotic structured products are pitched the same way. They dress up risk in the clothing of safety, knowing that seniors want reassurance more than anything else. The most heartbreaking part is the timing. In your 30s or 40s, a big dip in bonds or stocks can be an opportunity. You have time to recover. But in your 70s or 80s, time is not on your side. You don't get 20 years to wait for your investments to bounce back. Every dollar lost is a dollar that may never return. And when medical costs, inflation, or long-term care expenses are looming, that can be the difference between independence and dependence. So what should seniors do? The answer isn't to panic or to pull all your money out of bonds. It's to get clear about what you own. Do you hold actual bonds with maturity dates and predictable returns? Or do you hold bond funds that fluctuate daily? Do you know the duration risk, the sensitivity of your bonds to interest rate changes? If not, you could be sitting on a ticking time bomb. I often tell clients, it's not about avoiding risk. It's about knowing your risk. For some, that means shifting from bond funds to individual bonds or CDs where the rules are clear. For others, it means diversifying into assets that protect against inflation instead of just chasing yield. But what it never means is blindly trusting the word conservative printed on a fund's prospectus. Now, let me ask you, have you ever checked how much of your retirement account is sitting in bond funds? Type bond in the comments if you've ever looked at your statement and seen the word without really knowing what it means. Because if you're not sure, you may already be exposed to risks you never signed up for. And if you think bond funds are the only quiet wealth trap, wait until you hear what happens with another safe choice marketed heavily to retirees. Something that looks like a savings account but hides one of the most painful surprises I've ever seen in a retiree's portfolio. I'll tell you all about it in the next part. When seniors walk into a bank, they expect trust. They expect safety. They expect that whatever product is being offered will protect, not harm, the wealth they've worked a lifetime to earn. And yet, one of the most common products sold in bank lobbies across America, quietly siphons money from retirees every single year. I'm talking about certificates of deposit, CDs. Now, you might be thinking, wait, aren't CDs safe? They're insured. They can't lose value. And yes, technically they are insured up to certain limits, and yes, you'll get your principal back at maturity. But here's what almost no one explains to seniors. CDs can be one of the fastest ways to lose wealth, not through market crashes, but through erosion. Erosion by inflation, erosion by opportunity cost, and erosion by timing. Take Mr. and Mrs. Alvarez, a couple in their late 70s who came to me after their bank proudly sold them a special senior CD offer. The interest rate? 1.2% locked in for 5 years. The banker made it sound like peace of mind. No stock market stress, no losses. But here's what actually happened. Inflation averaged over 6% during those years. That means while their money was earning pennies in interest, the real value of every dollar was shrinking by dimes. When their CD matured, they hadn't lost a cent on paper, but in reality, they could buy far less with the same amount of money. The silent theft of purchasing power had robbed them of tens of thousands of dollars in real wealth. And then there's the issue of liquidity. Seniors often think, well, if I need the money, I'll just take it out early. But banks impose harsh penalties for early withdrawals, sometimes 3, 6, even 12 months of interest wiped away in an instant. If you're unlucky enough to need that money for a medical emergency, a home repair, or long-term care, the safe investment suddenly punishes you at the exact moment you need flexibility. The scariest part is that many retirees are encouraged to ladder CDs, tying up large chunks of their nest egg for years at a time. On paper, it looks diversified. In practice, it locks them into low returns while inflation and healthcare costs accelerate. I've seen seniors in their 80s trapped in 10-year CDs earning less than 2%. Their wealth was technically safe, but their independence was slipping away as the cost of living sprinted ahead. And let's not forget the opportunity cost. While money sits frozen in a CD, seniors miss out on safer but higher-yielding alternatives, treasury bills, Series I savings bonds, short-term municipal bonds, or even insured money market accounts that can pay 2, 3, even 4 times as much interest with equal or greater safety. But most don't know about these options, because banks rarely advertise what they don't profit from. I remember one client, Grace, an 83-year-old retired nurse. She told me proudly that she had over $400,000 in CDs. It's safe, and that's what matters to me, she said. But when we looked closer, her blended yield was barely 1.5%. Meanwhile, her assisted living facility had just announced a 7% increase in costs for the coming year. Grace was living off her CDs, believing they were her lifeline, but in reality, they were dragging her underwater. The cruel irony is that by avoiding the risk of the market, she had embraced the certainty of losing ground every single year. Here's what every retiree needs to hear. Safety isn't just about avoiding losses on paper. It's about preserving purchasing power. If your safe investment earns less than inflation, you are losing money, even if your account statement looks stable. And unlike market losses, which can sometimes be recovered, the erosion of purchasing power is permanent. Once your dollar buys less, it never buys more again. So what's the solution? It doesn't mean abandoning CDs completely. They can serve a purpose in a balanced plan, short-term cash needs, emergency reserves, or very risk-averse funds. But they should never make up the bulk of a retiree's savings. Instead, seniors should be shown alternatives that actually protect against inflation while preserving safety. Unfortunately, those alternatives are rarely explained at the local bank counter. Now let me ask you, do you know the real rate your CDs are earning right now compared to inflation? Type CD in the comments if you've ever locked into one without thinking about the hidden cost. Because if you're depending on CDs as your main retirement strategy, you may be bleeding wealth quietly, dollar by dollar, year by year. And if you think CDs are bad, wait until you hear about the next wealth trap. It's something seniors are lured into because it sounds like insurance, like protection. But in reality, it's a financial product that blends investment and insurance into one complicated package that too often leaves retirees poorer, not richer. I'm talking about whole life insurance and other cash value policies, and what I'm going to reveal about them may shock you even more. I can't tell you how many times I've sat across from seniors who proudly say, "Don't worry, I'm covered. I bought a policy that builds cash value, so my money is safe, my family is protected, and I'll never be a burden. And every time, my heart sinks. Because for decades, seniors have been sold one of the most misunderstood and most expensive products in the financial world: whole life insurance and its cousins, universal life, indexed universal life, and variable life policies. The pitch is always the same. A trusted agent, often a familiar face in the community, explains how these policies provide lifelong coverage, guaranteed cash value, and even a tax-free way to grow money. It sounds perfect: protection plus investment, all in one neat package. But here's the truth most retirees don't discover until it's too late. These policies are not wealth builders. They are wealth drainers. Let me explain why. First, the fees. Hidden inside every premium are layers of commissions, administrative costs, mortality charges, and investment expenses. In the early years, sometimes the first 10 to 15, almost none of your money goes toward building cash value. It goes to pay the insurance company and the agent. That's why many retirees are shocked when they check their policy's surrender value after years of payments and see a number far lower than they expected. Take the story of John and Margaret, a retired couple in their 70s. They bought a universal life policy 20 years earlier, told it would give them lifelong protection and a growing nest egg. They faithfully paid $500 per month for decades, nearly $120,000 total. But when John developed health issues and they needed cash for medical bills, they discovered their policy's cash value was barely $45,000. Where had the rest gone? Fees, mortality charges, market-linked investments inside the policy that underperformed. The so-called guarantee they believed in was never designed to protect their savings. It was designed to enrich the insurer. And then there's the illusion of tax-free loans. Agents love to highlight how you can borrow against your cash value and never pay taxes on it. What they don't tell you is that those loans accrue interest. That interest piles up. And if you don't keep paying premiums plus loan interest, the policy can implode. When that happens, the IRS steps in, treating the entire gain as taxable income, often at the worst possible moment. I've seen retirees blindsided with tax bills of tens of thousands of dollars because a policy they thought was safe collapsed under its own weight. The saddest cases are those where policies lapse in the later years. Premiums climb as you age because the cost of insurance rises, and many seniors on fixed incomes can no longer keep up. They've poured in tens of thousands of dollars, only to see the policy vanish when they need it most. The insurance company keeps the money. The family gets nothing. One client, Helen, a widowed grandmother of 4, told me through tears, "I thought I was leaving my children a gift. Instead, I left them with nothing." She had paid into her policy faithfully for 25 years. But at 82, the premiums jumped so high she couldn't keep up. The policy lapsed, wiping out her coverage and leaving her with only a small surrender check. A lifetime of careful planning gone in an instant. Here's what every retiree needs to understand. If your goal is to protect your loved ones, simple term life insurance often does the job at a fraction of the cost. If your goal is to grow wealth, there are far more efficient, transparent ways to do it than through a life insurance contract. Whole life and its cousins are not investments. They're insurance products engineered with layers of complexity that benefit the companies, not you. The marketing preys on fear. Fear of running out of money. Fear of burdening children. Fear of estate taxes. But the reality is that most seniors don't need complex insurance policies in their 70s and 80s. They need liquidity. They need control. They need income that doesn't vanish into hidden charges. So, let me ask, do you know how much cash value your policy actually has right now? Do you know what fees you're paying, or what happens if you stop paying premiums? Type policy in the comments if you've ever wondered whether your life insurance is truly helping you or just quietly draining your wealth. Because if you don't know, you may already be sitting on a time bomb. And here's something else. Many seniors are being pitched newer versions of these products, indexed universal life, for example, sold as market upside with no downside. But scratch the surface and you'll see the same traps: caps on returns, hidden fees, complicated formulas you'll never fully understand, and long surrender periods that keep your money locked up. I call these products financial quicksand. Once you step in, it's nearly impossible to get out without sinking deeper. This is why I always tell my older clients, keep your finances simple, transparent, and flexible. If you can't explain how your investment works to your spouse or your children in one sentence, you probably shouldn't own it. Now, if the idea of life insurance draining your savings surprised you, just wait. Because the next wealth trap is even more seductive. It comes dressed as free advice. It looks like a friendly broker helping you choose funds for your retirement account. But behind the curtain, it's loaded with commissions and hidden conflicts of interest that quietly bleed retirees dry. And in the next part, I'll show you exactly how it works, and how to protect yourself before it's too late. When I ask retirees how they chose their investments, most of them smile and say, "Oh, my broker takes care of that. He's been with me for years." There's a comfort in that relationship, a belief that the person across the desk is a trusted guide. But here's the hard truth I've seen again and again. Many brokers are not advisors. They are salespeople. And the investments they recommend, mutual funds, annuities, senior-friendly products, are chosen not because they're the best fit for you, but because they pay the highest commission to them. This is one of the most painful wealth traps I see. Seniors walk in expecting advice. What they often get is a sales pitch wrapped in financial jargon. The glossy brochures, the pie charts, the safe growth labels, it all feels official, even protective. But what's happening behind the scenes is a transfer of your retirement savings into products with high fees, long lockups, and mediocre performance. Take the story of Robert, a retired engineer in his late 70s. He trusted his broker like family. For years, he followed every recommendation, believing the man had his best interest at heart. Robert invested in a series of actively managed mutual funds with expense ratios of 1.5% or higher. At first, the difference was invisible. The market was rising, his account balances looked fine. But over a decade, those fees quietly devoured more than $150,000 of his wealth. Money that should have gone to Robert and his wife went instead to fund managers and commissions. When I showed him how an index fund with a 0.05% fee would have left him with that extra $150,000, he put his head in his hands. "I thought he was protecting me," Robert whispered. And that's the tragedy. Trust misplaced can be one of the most expensive mistakes in retirement. Here's what most seniors don't realize. Every extra percent in fees can cut your retirement income by tens of thousands of dollars. If you're withdrawing from your portfolio to live on, high fees act like termites. Slowly, silently, they chew through your woodpile until one day, you wake up and realize the structure isn't as strong as you thought. And it doesn't stop there. Brokers often push investments with loads, front-end or back-end sales charges. That means the moment you put your money in, 3% to 5% disappears into the broker's pocket. Imagine handing over $10,000 and seeing $500 vanish before your money is even invested. That's not advice. That's a transaction disguised as guidance. I'll never forget Maria, a retired school secretary who came to me after her husband passed away. She had $250,000 in life savings, carefully built over 40 years. Her broker moved her into a balanced fund that carried a 5% front-end load and a 1.25% annual fee. By the time Maria realized something was wrong, she'd already lost nearly $20,000 to fees and charges alone. "I thought I was safe," she said, "but I was just paying him to get rich." The saddest part? Many seniors never even know they're paying these fees. Statements are complicated, numbers are buried, and the real costs are hidden in fine print no one ever explains. By the time they notice, the wealth drain has already taken its toll. So how do you protect yourself? First, ask one simple question: are you a fiduciary? Fiduciaries are legally bound to put your interests first. Brokers are not. If the person managing your money can't say yes to that question, you may be dealing with someone whose loyalty is to their commission, not your retirement. Second, demand transparency. Ask exactly what fees you're paying, both visible and hidden. If you don't understand the answer, keep pressing until you do. If the explanation sounds evasive, that's a red flag. Third, simplify. Complex investment products are often designed to confuse. If you can't explain in plain English how your money is working for you, it's likely working against you. Let me ask you this. Have you ever wondered if your broker is making more from your money than you are? Type "advisor" in the comments if you've ever questioned whether your financial guidance is truly unbiased. Because if you haven't asked that question, You may already be paying for conflicts of interest without realizing it. And here's the most unsettling part. This isn't just about money. When seniors lose wealth to high fees and commissions, they lose choices. Choices about healthcare, housing, travel, and independence. Every dollar siphoned away by conflicted advice is a dollar you can't use to protect your dignity in retirement. But if you think broker commissions are bad, wait until you hear about the next wealth trap. It's something almost every retiree uses daily. Something they think of as convenient, even necessary. But hidden inside it are some of the steepest costs in the financial world. Costs that can bleed away savings faster than any investment ever could. I'm talking about credit and debt in retirement, and in the next part, I'll show you exactly how it robs seniors blind. One of the most painful moments in my career as a financial advisor was sitting with a retired couple who had done almost everything right. They worked hard, saved steadily, and avoided risky investments. On paper, their retirement plan looked solid. But when we dug into their finances, I saw something that made my stomach sink. They were buried in credit card balances they thought were temporary. Month after month, interest charges were quietly consuming thousands of dollars. And the cruelest part? They never realized how destructive debt can be after 60. This is one of the most overlooked wealth traps for seniors. Credit cards, personal loans, even medical debt. For working adults, debt can sometimes be managed by higher income or extra hours. But in retirement, with fixed income and rising expenses, debt becomes a predator. It grows while you sleep, while you eat, while you try to rest. By the time many seniors wake up to it, the damage is already enormous. Let me tell you about Barbara, a 74-year-old widow who prided herself on being independent. She used her credit card for groceries, prescriptions, and the occasional gift for her grandkids. She always planned to pay it off next month. But with inflation raising her grocery bills and an unexpected dental surgery, next month never came. By the time she sat down with me, Barbara owed over $18,000 at an interest rate of 21%. Her minimum payments barely covered the interest. She was essentially paying the bank hundreds of dollars a month for the privilege of staying in debt. "I thought it was just a little help," she told me. "I didn't realize it would trap me." And she's not alone. More than half of Americans over 65 carry credit card debt. The average balance is over $7,000. At today's interest rates, that means thousands of dollars a year evaporating into bank profits. Money that could have gone toward healthcare, home repairs, or just enjoying life instead vanishes into fees. But it's not just credit cards. Medical debt is another silent drain. Seniors on Medicare often assume everything is covered. But co-pays, deductibles, and uncovered procedures pile up quickly. Hospitals and clinics encourage easy payment plans, which sound manageable but often come with interest or late fees. I've seen retirees lose entire savings accounts to unexpected medical bills spread out over years of payments. Then there are reverse mortgages, another form of debt disguised as help. The commercials make them sound like a lifeline. Stay in your home and get money every month. What they don't emphasize is that fees are sky high, interest accumulates, and in many cases, the equity you worked decades to build can vanish, leaving little or nothing for your heirs. One of my clients, Harold, an 81-year-old Korean War veteran, took out a reverse mortgage to cover rising expenses. At first, it felt like a blessing, extra cash flow with no monthly payment. But within 10 years, the loan balance had ballooned. When Harold passed, his children were forced to sell the home they grew up in just to cover the debt. The equity was gone. The legacy was gone. "Dad thought he was helping us," his daughter told me. "Instead, he left us nothing." Here's the truth. In retirement, debt is a double thief. It steals your wealth and your peace of mind. The stress of bills, collection calls, and rising balances eats away at health, happiness, and even relationships. I've seen couples in their 70s arguing over credit card charges. I've seen proud men in their 80s reduced to tears because they couldn't cover a hospital bill. Debt doesn't just cost dollars, it costs dignity. So what can you do if you're already in debt? First, stop ignoring it. The worst thing you can do is hope it will disappear. Make a full list of every debt, balance, interest rate, and monthly payment. Most seniors are shocked when they see the totals in black and white. Second, prioritize. Tackle high-interest debt first, even if it means making only minimum payments on the rest. Every dollar you knock off a 20% credit card balance is like earning a guaranteed 20% return on your money. Third, look for consolidation options. Sometimes a personal loan or a home equity line of credit at a lower rate can save thousands compared to dragging out credit card debt for years. And most importantly, change how you use credit. At this stage of life, debt should never be a routine tool. It should be a last resort. If you can't pay off a purchase in full within the month, ask yourself if it's truly necessary. Because the cost of carrying debt in retirement is far higher than the cost of going without. Let me ask you, have you ever carried a credit card balance into retirement? Type debt in the comments if you felt the weight of monthly payments eating away at your peace of mind. Because admitting it is the first step toward freedom. And here's the key lesson. Retirement is about preserving independence, not paying interest. Every dollar you give to a bank or lender is a dollar you can't use to protect your health, your home, and your loved ones. That's why I tell every senior I meet, your financial enemy is not just bad investments. It's debt. But if you think credit cards and reverse mortgages are the end of the story, you're mistaken. Because the final and most dangerous trap I see doesn't come from Wall Street or banks. It comes from seniors themselves, choices, habits, and beliefs about money that quietly sabotage their future. And in the next part, I'll show you how to recognize and stop them before they take everything you've worked for. Over the years, I've learned something important. The greatest threat to senior wealth is not just Wall Street, or banks, or insurance companies. It's not even the debt traps that lurk in credit cards or reverse mortgages. The greatest danger often comes from within, our own habits, our own assumptions, our own decisions that feel small in the moment but compound into disasters over time. I've watched retirees sabotage their own financial futures in ways they never intended. Not because they were careless, but because they didn't know better. They trusted outdated rules, old advice, or their gut instincts from decades ago. And while those instincts may have worked when they were 30 or 40, they can be catastrophic after 60. Take the belief that cash is king. Many seniors pile their life savings into checking and savings accounts, terrified of risk. On the surface, it feels safe, money in the bank, easy access, no market swings. But here's the truth, a dollar sitting in cash today will buy less tomorrow, and even less a year from now. Inflation is relentless. At 3%, it cuts your purchasing power in half in just 24 years. At 6%, the damage is even faster. That means the very act of playing it safe can quietly rob you of the ability to afford healthcare, housing, and daily necessities. Then there's the habit of helping adult children financially. I've seen parents in their 70s drain retirement accounts to pay off a child's mortgage, fund a grandchild's college tuition, or bail out a struggling business. The intention is noble, but the result is often devastating. Unlike when you were younger, you don't have decades to rebuild what you give away. I've counseled seniors who gave their children $50,000 thinking it was a one-time gift, only to face medical emergencies of their own with no savings left. I wanted to be generous, one grandfather told me, but I ended up needing help myself. Another common trap is chasing hot tips or trends. Seniors see headlines about booming stocks, cryptocurrencies, or new technologies and think, maybe this is my chance. They invest without understanding, hoping for quick gains. But speculation is not a retirement strategy. I've watched retirees lose six figures overnight because they bought into hype. At 35, you can recover from a bad bet. At 75, there's no time left. And perhaps the most destructive habit of all, silence. Too many seniors avoid talking about money, out of embarrassment, pride, or fear. They don't tell their spouse the full picture. They don't share details with their children. They don't ask questions of their advisor because they don't want to seem foolish. But silence is expensive. It prevents problems from being solved until they've grown too big to fix. Let me tell you about Carol, an 82-year-old retired nurse. She was private about her money. Even her daughter didn't know the details. Carol believed she was fine, until a fall put her in the hospital. That's when her family discovered she had over $40,000 in credit card debt, multiple high-fee annuities, and almost no liquid savings. The family was blindsided. If only she had told us, her daughter said, we could have helped before it got this bad. Carol's silence cost her not only her wealth but also her independence, as she had to move into assisted living sooner than she ever wanted. So what can you do to avoid these self-made traps? First, be honest with yourself and with your family. Look at your finances with clear eyes. Don't assume you're safe just because you're avoiding risk. Second, make decisions based on today, not yesterday. The financial world has changed. Interest rates, healthcare costs, longevity, they're all different than they were 20 or 30 years ago. Your strategy must change too. Third, simplify. The more complicated your finances are, the easier it is for mistakes to hide. Clarity is your best defense. And finally, remember this: protecting your wealth in retirement is not just about money. It's about freedom. It's about dignity. It's about being able to choose where you live, how you're cared for, and how you spend your final years. Every dollar you preserve is a choice you get to keep. Every dollar you lose unnecessarily is a choice taken away. So, let me ask, have you caught yourself falling into any of these habits? Hoarding cash. Helping children too much. Staying silent when you should speak up? Type habit in the comments if you recognize one of these patterns in yourself or someone you love. Because awareness is the first step toward change. The truth is, retirement doesn't have to mean watching your wealth slip away. With the right knowledge, with clear eyes and honest conversations, you can avoid the traps that drain seniors dry. You can protect not just your savings, but the life you've worked so hard to build.